Welcome to the Bullvine Podcast, your premier destination for exclusive insights, pioneering research, and fresh news in the dairy farming sphere. In today's episode, we look at the weekly global dairy market jumps, supply concerns amid record butter sales, and weather challenges. So please grab a glass of milk, sit back, and let's get started with this week's episode.
Is the dairy business on the verge of a revolution? Last week's massive price increases across all dairy commodities on the CME spot markets, a clear indicator of market volatility, may have hinted at this. These eye-catching improvements are driven by rising supply issues, with avian influenza making California's milk production tighter than initially projected. Sweltering temperatures continue to limit productivity in this critical dairy state. In a historic twist, butter sales reached an all-time high of 161 loads, breaking the previous record by an astonishing 32 loads. What does this signify for the future of dairy production? In this context of catastrophic weather occurrences and frenzied purchasing habits, we go under the surface to uncover deeper insights and ramifications for people at the core of the business.
The global dairy market is experiencing significant instability, with recent increases in all dairy commodity prices on the CME spot markets. A fresh wave of supply worries mainly drives these price increases. California, a key participant in the U.S. dairy industry, faces two significant challenges: the unanticipated severity of avian influenza's effect on milk output, which has led to higher than expected death rates among impacted dairy cows, and relentless hot temperatures. The influenza epidemic has resulted in higher than expected death rates among impacted dairy cows. At the same time, the extreme heat has placed further pressure on the state's total milk production. In contrast, some areas like the Midwest benefit from favorable meteorological conditions, increasing output levels.
California's dairy sector is in jeopardy as renewed supply worries loom. The combination of avian influenza and persistently high temperatures severely challenges the milk supply. Avian influenza, first underestimated, causes higher than expected death rates in infected herds, reducing the available milk supply. California's prolonged heat and this biological danger may affect milk output as cows battle heat stress and limited pasture. On the other hand, circumstances in the Midwest provide a contrastingly brighter image. Cooler temperatures have made this location more conducive to dairy production. The availability of high-quality feed reinforces this optimistic view, increasing the amount and quality of milk produced. These optimum circumstances reduce production stress and help maintain constant milk component levels, resulting in a more stable supply line. How does this affect dairy farmers? Are you ready to face these obstacles and profit from the opportunities? The contrast between California's troubles and the Midwest's benefits emphasizes the significance of flexibility and strategic planning in the ever-changing dairy market.
More considerable spot market prices cast a lengthy shadow over futures prices, giving the market a new sense of confidence. When we examine the financial trajectory of Class 3 and Class 4 milk, we see that both are at exciting junctures. Class 3 futures rose beyond $20 per seg of wheat in the first quarter of 2025, while Class 4 futures have consistently been above $21 per seg of wheat this year. These pricing levels reflect a bullish confidence that dairy farmers may profit from. Several economic considerations are supporting the rise of dairy production. Moderate operating expenses continue offering producers favorable profits, driving up production. Furthermore, advances in milk component levels, particularly in colder Midwest areas, indicate a hopeful future. Despite the limits provided by restricted heifer supply and processing delays, the overall economic climate is still favorable enough to encourage producers to increase their production levels. This situation invites a fundamental question. Are we seeing the start of a period of sustainable development, or are current favorable circumstances only a temporary respite in a historically volatile industry? Your opinions are crucial. Please leave your thoughts in the comments section below, and let's start a positive discussion about the future of dairy farming.
There is much to think about regarding demand dynamics and the cheese market. U.S. cheese exports remain stable globally. This strong demand is partly due to competitive pricing, particularly when players like mozzarella and cheddar step up. Mozzarella, in particular, is seeing a surge in popularity, practically coinciding with the emergence of global meal packages and fast casual restaurants. What's causing this cheesy infatuation abroad? Have Americans discovered the secret to taste preferences worldwide? Domestically, the story is more complicated. While mozzarella is growing in popularity, as seen by the persistent promotion of processed cheese mixes, cheddar sales remain mixed. Are we over cheddar? Unlikely. Instead, there's a rising interest in flavor variations and texture. Cheddar is holding down the fort, but needs to lead the route as it did in previous years. Could this be a call to innovate inside our borders? And with the Christmas season approaching, the story tightens. Historically, this has been a good time for cheese sales due to increased parties and culinary experimentation at home. An increase in sales is nearly guaranteed. The issue is, how large will it be? Will mozzarella and cheddar dominate, or will other challengers steal some of the spotlight? Readers, how do you picture the cheese aisle at your local supermarkets this Christmas season?
This week, the butter market saw a flurry of activity, with 161 cargoes exchanged, marking a historic event. This enormous activity raises the question, what is causing such huge volumes? Supply issues in California, worsened by avian influenza and excessive heat, are also significant causes. They are changing market dynamics as investors scramble to secure stock. However, the narrative still needs to finish here. Butter prices in the United States have become particularly appealing worldwide. Even when European prices fall from their highs, U.S. butter remains a formidable challenger. This competitive pricing is more than a reactive response. It is a purposeful move to capitalize on the existing global supply-demand balance. The potential for U.S. butter to increase its foreign market share is accurate and supported by convincing market data. Despite all this activity, the price rise was a modest 3.5 cents, closing at $2.66 per pound. This exemplifies the complicated buyer behavior, active yet price-sensitive. As market players manage this optimistic trend, the balance between stockpiling inventories and maintaining cost efficiency becomes clear. With the churn still in full motion and cream supplies plentiful, this is a time of opportunity and difficulty. U.S. companies' capacity to send items overseas reflects competitive pricing and a larger goal of boosting the U.S. presence in global markets. This narrative could change the traditional geographical strongholds of dairy exports.
The non-fat dry milk (NDM) industry is an intriguing example of long-term stability in the face of external pressure. With stocks being noticeably tight, the spot price of NDM has scarcely changed, rising to $1.38 per pound as of last Friday. Despite significant supply limits mainly resulting from California's production issues, this stagnant price environment implies a market playing a cautious waiting game. Will tightening inventories eventually result in a more noticeable price movement, or will demand remain weak under present pressures? Meanwhile, the dry whey market is an exciting example of supply-demand equilibrium. Last week's minor price increase to 60.25 cents per pound reflects an underlying balance that has kept the market stable within a restricted range. Despite restricted supply and high-protein space needs, the dry whey market seems to be positioned for possibly positive action. The scarcity of raw whey accessible for dry whey manufacturing, owing to the strong demand for protein supplements, is a fascinating dynamic. Are we about to see a massive shakeup in this dairy market segment?
The whirling winds of the grain markets have been a quiet collaborator in recent dairy storylines. Favorable weather conditions in crucial agricultural areas recently resulted in a minor easing of grain prices, which relieved dairy producers concerned about their milk margins. Lower feed costs imply more excellent financial space to handle other operational demands. But are we becoming too comfortable? Geopolitical issues, notably those involving Ukraine, have long plagued the global grain trade. As assaults on grain storage and transportation facilities continue, there is a growing concern about widespread supply disruptions. This conflict creates an unstable floor for grain prices, endangering the delicate equilibrium that farmers now enjoy. This unstable background requires dairy producers to be vigilant. The favorable milk margins, driven by low feed prices, may encounter problems as geopolitical issues in Eastern Europe impact grain price trends. The contrast between this possible volatility and the relatively calm feed cost picture indicates that intelligent financial planning and market monitoring will be critical for future success.
The global dairy trade auction on October 15th revealed a problematic scenario for dairy commodities, with the index declining by 1.2%. Let's examine this recent development. It wasn't quite a watershed moment for dairy prices, but a combination of tiny successes and failures. The price of whole milk powder, WMP, has remained stable. Why does this matter? WMP isn't simply another commodity. It accounts for more than half of the global dairy trade index. So, while WMP prices stay steady, they effectively anchor the index, limiting further decreases. Stability signifies steady support and demand, reducing volatility in the market. Meanwhile, documented price differences in other products could not significantly tilt the balance. Anhydrous milk fat and cheddar cheese increased marginally, providing a beacon of hope in the mix. Cheddar cheese prices increased by 4.2% to $2.13 per pound, indicating continued interest, potentially spurred by solid overseas demand. However, butter and lactose levels fell, reflecting diverging patterns that offer a more complete picture of the market's present situation. These findings highlight the complex interplay between supply and demand across geographical geographies. Understanding WMP's weight on the index may help dairy business professionals make better forecasts and strategic decisions. It's a clear warning to market players to be watchful, if not nimble, since navigating these undulating waters requires a close eye on every moving part.
The European dairy industry has displayed exciting trends, particularly in the butter, skim milk powder, SMP, and cheese sectors. A broad decreasing trend has emerged, with butter leading the way with a considerable decline. Over the last few weeks, average butter prices have fallen by €509, or 6.4%. SMP prices have also weakened, falling 2.9% within the same period, indicating a gloomy market attitude throughout the continent. Cheese markets have not been spared, with losses reported, notably in the mozzarella and cheddar variants. These pricing changes have far-reaching ramifications, particularly for the global dairy sector. With European butter and SMP prices falling, there is a chance to compete against other major exporters like the United States and New Zealand. Lower European pricing may encourage worldwide purchasing, boosting the region's global butter and SMP market share. However, cheese exports produce inconsistent results, driven by home and foreign demand. Ultimately, these price changes reflect the volatility and interconnectedness of global dairy markets. To guarantee competitiveness in an ever-changing marketplace, stakeholders should consider these dynamics when developing future trade strategies.
As we've examined the dairy business more closely this week, we've found that it's fraught with issues and opportunities. The comeback of dairy commodity prices on the CME spot markets, along with California's challenges with avian influenza and hot temperatures, complicates the situation for farmers. The global dairy trade auction results provide contradictory signals, with certain commodities rising and others falling, reminding us of the fickle nature of global demand. Meanwhile, cheese and butter are increasing, fueled by local innovation and worldwide rivalry. This provides dairy makers an excellent opportunity to capitalize on growing consumer preferences and possible new markets. The non-fat dry milk market's stable but cautious outlook highlights the need for strategic planning to reduce risks, especially in California's manufacturing heartland. In the larger agricultural environment, grain prices provide a silver lining by increasing profit margins even as global geopolitical concerns rise. European dairy dynamics highlight how intertwined these markets are, impacting everything from price to exports. These variables raise the question of how dairy farmers and industry experts will modify their operations to flourish in this volatile market. Please share your ideas and solutions below or participate with the community. Your insights and experiences will be essential as we navigate these stormy times together.
Thank you for tuning in to the Bullvine Podcast. We hope you enjoyed today's insightful discussion. Don't forget to subscribe, share, and leave a review. Catch you next time on the Bullvine Podcast, where bovine expertise and community come together.